Bloomberg Audio Studios. Podcasts, radio, news. This is Masters in Business with Barry Ritholtz on Bloomberg Radio.
This week on the podcast, another extra special guest, Neil Dutta, with a tour de force explanation on what a market economist is, how it's their job to take all of the academic and somewhat esoteric economic research and take it from the 5-yard line into the end zone. Why it's so important to put stuff into context that investors can use to focus on not just merely the economic data, but what it means for different sectors of the economy, what it means for different companies. I always find Neil fascinating to listen to. He has a really great track record forecasting things in a way that is occasionally out of consensus. So when he's talking about inflation in 2021 or Fed hikes in 2022 or why we weren't going to see a recession in that same year, it's always fascinating to see somebody whose thought process is detailed and interesting and out of consensus, but also right. I thought this conversation was fascinating, and I think you will also. With no further ado, my conversation with head of economic research at RenMac, Neil Dutta. So last time we were here, we talked about a bunch of things that you got right. I know your views have evolved. We'll get to some of those, but let's just go over your background a little bit. Bachelor's in economics and political science from New York University, from NYU. Was the original career plan to go into finance?
No. I mean, when you go to college, you don't know that jobs like the one I'm in currently even exist. Right. It's like, you mean to tell me I get to write about economics and talk all day long and someone will pay me for it?
No manual labor.
Yeah. And so, I had no idea. I mean, I knew that I had an interest in economics. I had an interest in political science. The original plan was actually, maybe to go to law school. But I ended up, just not doing as well as I thought I was going to on the LSAT. So my senior year of college, I was kind of scrambling because I didn't want to go to school for another 3 years, but I wanted to stay in the city. And I was just like, let me just try to get into Merrill Lynch. Or it's not at Merrill Lynch. I mean, I got into Merrill Lynch, but any of the bulge bracket banks in the city, right?
Had good, back in the day, they all had good training programs.
Yes. So that was the goal, is to get into one of the analyst programs at the bulge bracket banks. So I got into to Merrill Lynch. I actually started off there as a compensation analyst. And
meaning studying labor, studying salaries and things like that.
Well, right. I mean, yeah. I mean, a lot of what the job was in the amount of time that I had done it was, I mean, a lot of it is just benchmarking the employees of the firm to the market to make sure that you're paying people to market.
Meaning internally, you were looking
internally.
At Merrill Lynch. Oh,
yeah,
that's
and
very
managing the year-end bonus pools. So that was a whole process in and of itself. But one of the good things about working in HR is that you so I got my foot in the door. I mean, I was just happy to have something at that point. I remember I showed my mother my offer letter. I still have it saved from Merrill Lynch, where they were paying me $50,000 with a $10,000 signing bonus. And I showed that to my mom, and she was like, why would they be paying you this much money? And I was like, well, I don't know.
We'll find out soon.
Yeah, we'll find out what I'm going to be doing. But the benefit of working in HR in particular is that you kind of know where all the jobs are and where the open positions are in the firm. And there was an open position on David Rosenberg's team at Merrill Lynch. And so then I joined his team. That was in late 06 or early 2007. So, right when Rosie was really killing it. I mean, he was like a marketing machine. He was like the guy, like number one in II. Like all these things were happening, I mean, and so it was really exciting to be on his team. So it was like a very quick education. I mean, it was a real education being on his team during that time.
Say nothing of what happened over the next few years, 08, 09, and the great financial crisis was right around the corner.
Yeah, I mean, I definitely think that, one of the things that I've always come to believe now, like having been in the business for a long time, is that, as you know, the financial industry is very cyclical, right? Like everyone knows someone who's been laid off, let go, has gone through spells of just not having a job, right? And I do think it says something about you if you've been able to survive these crises.
To say the very least. Where was Barron's in your career history? You were an analyst at the weekly Dow Jones publication.
Yes,
Barron's.
I mean, that was more of a when I was in college. I worked for Gene Epstein.
Oh, really?
Yes, noted libertarian. Kind of gave me my first taste of like a lot of the tools that we use now in sort of the business economic space, like Haver Analytics. I actually got my first taste of that working with Gene at Barron's. And, getting my, sort of first sense of, trying to analyze data, looking at, he had sort of a weekly column on the economy, but a lot of the interesting pieces that he wrote would happen on, days of like the employment report or, summarizing the ISM data and like what it might mean for the economy and the outlook. So it kind of gave me my first taste of what a business economist would do. On a day-to-day basis.
I've noticed you use the phrase market economist or business economist all the time. How does that differ from the traditional economist, for lack of a better word?
Well, I don't have like formal PhD training, so I think, that to me is like an important distinction. Mm-hmm. You have business economists on the street that have PhDs. But I don't think a PhD is required to be a business economist. And to me, it's like also just a way to respect the academic profession, right? I mean, you have people here that are really studying a specific niche area their entire careers, right? I mean, you think about like behavioral economics and like financial economics. I mean, there are economists that are just looking at that. And they're doing it for decades, right? Because that's what they do. And
I think a Hyman Minsky looking at the narrow subtopic of stability and instability in economic systems and toiling away for decades until eventually the market hits a tipping point and suddenly all of this research that seems like a quiet backwater
becomes
is suddenly
relevant.
Yeah, becomes front page news.
Or just, or like strategic trade theory. I mean, these are all sorts of things that have I think, and you could say maybe, and the academics take you basically to the 5-yard line, and as a business economist, your job is to kind of run it in for a touchdown and tell the investor community, like, why is this important to what you're doing right now?
That's very interesting descriptor.
So that's sort of the way I kind of view it. I mean, obviously you lean on a lot of their work throughout your career. I mean, this had gotten a lot of play earlier in the cycle, but Ed Leamer wrote a paper once called "Housing is the Business Cycle," right? Mm-hmm. I mean, and that was
professor at Harvard or Georgetown?
I think he was in University of California, if I'm not mistaken. But at any rate, I mean, that was a piece of research that had gotten a lot of attention over the years. When housing was melting down back in 2022, a lot of people were leaning on that paper again. So it's important. I mean, so to me, it's like I make that distinction because I don't have a PhD, and I'm not doing the same thing. What I'm basically trying to do is look at all the different sort of pieces of economic information that come out. And on the U.S. economy, there's always something going on, right? I mean, in terms of data, some of it's marking movement, some of it's not, and try to kind of formulate an economic outlook that is useful for investors. That is not what academics tend to do, right?
For sure. So when you were at Bank of America-Merrill Lynch, you were doing a weekly note you authored. How did that help carve out your own space and expertise, and how did that ultimately lead to your job at RenMac?
Well, so I mean, obviously Merrill was an interesting time because I was sort of coming up the ranks, and by 2009, Rosie had left, mm-hmm. and so it was sort of this weird time where it was like a very important time in the economy, because we were just transitioning from recession to expansion. And but Merrill's economic team was kind of without a leader. right? So we didn't really have. So I was able to do a lot at that time, just by default, because there was no one else really doing it. So I would be writing a lot for especially for the equity market desk.
You had to be pretty young back in 2009.
Yeah, I was very young. I might have been like, oh God, I don't know, like not even 30. Right?
Wow.
So, at any rate, so I mean, it's one of these things where if it's just you and like a couple of other people, you're doing a lot more than you otherwise would be doing had there been like a formal chief economist. So I remember the summer of 2009 vividly, because we had, like the team had gotten like a big reputation for being very bearish because
Rosie.
because of Rosie, but
still bearish.
Yeah, but by March, by the time he had left, and by the second quarter of 2009, it was becoming increasingly clear that things were kind of turning around, right?
Mm-hmm.
I mean, credit markets had turned. It looked like housing wasn't getting any worse, right? Inventories had basically been cut to the bone; they couldn't go any lower, and so we had written a piece basically talking about how, the recession's over, like that's it, and that had gotten a lot of attention from our sales desk. But that's, to me, like, you talk about writing. One of the things that I've noticed like recently is just it's just ubiquitous, right? Like everyone's writing. Like it's just
peak Substack.
Yes, it's like, come view me on my Substack, and like there's like all this research. But to me, like what's important in the research sales business, because that's ultimately what I'm in, right? Mm-hmm. It's about knowing when to say something,
Right.
And there's just a lot of like filler research that comes out.
I love the word filler because it's literally all it is.
And there's some important. I mean, I do think it's important for clients to kind of see that continuity, but it doesn't have to be some written product. So to me, one of the things I've learned is like, when you write something, make sure that it has some depth and it serves a purpose, right? And so.
As opposed to just cranking something out daily or weekly
because
for a deadline.
It's like that. Eventually, like that turns into spam, right? Mm-hmm. I mean, from the perspective of your client. So right. there's many ways to kind of touch people in terms of accounts, like your client base that are paying for your research and your views and your analysis, and that could and some of that's written, some of that could be presentations, some of that could be podcasts, some of that could, it could be, it's that to me is what's important. So, writing in the beginning was important, but I think one of the things I learned very early on is that it's important to kind of say something that has meaning. And that's not always going to be the case, mm-hmm. right? Like, people don't need to hear from me every day. They need to hear from me when my views on something are working out or not. Right?
I like to say nobody really cares about ISM or fill in the blank, whatever your least favorite economic data point is.
Right. I mean, and also these days, right, like the market reaction to it is immediate. So you can pretty much tell right away whether the number was good or bad or whatever else, right? So what do I need to read your analysis for? And so it's, you kind of have to pick your spots about when to, try to chime in and provide some kind of useful context for these data points.
So there's a little bit of a void in 2009 after the head of the economics coverage for Merrill Lynch departs, and you somewhat fill that void, 9, 10, 11. What leads you to join RenMac in 2012?
Well, so by the fall of 2009, we had Ethan Harris from Lehman joined. He was named the chief U.S. economist, basically, and he was from a fixed income shop. I mean, Lehman was a huge fixed income shop. Mm-hmm. Ethan was a Fed economist, so his passion was really more towards the fixed income markets. And so, but obviously Merrill was like a huge, like a legacy equity shop.
Sure.
Yeah, and so I kind of got a lot of cut my teeth with the equity sales force. And what I tried to do, and one of the things you do find out in the research business is that fixed income doesn't pay for research. It's just that's what it is, right? I mean, you look at
the margins are smaller. The basically what is it, Barry, like 5-to-1 ratio?
Yeah, you think about like the biggest names in research sales over the last number of decades. You think about people like Ed Hyman, Nancy Lazar, right? You think they're writing about like rates? No, they're writing about like how economics can be tied into a stock market call. And Rosie, to his credit, was great at that. And that's kind of what I tried to do when Ethan was running things, because he didn't really do that, you know. And so he kind of let me run with it, and he kind of gave me a lot of latitude to kind of come up with my own ideas and try to tell, you know, an equity sales force, like, why is this important for your clients? Like, and because Merrill had so many equity analysts, there was like a wealth of opportunity, right? Like, so let's say we wanted to write a piece on business investment, right? Like, so why is that important for equities? Well, because a lot of EPS comes from CapEx. And now you can go talk to your industrials analysts. You can talk to the machinery analysts and say, like, you know, are you guys bullish or bearish on your names? Like, and if you can come up with a scenario where a macro view can tie into a specific stock sector view for an equity salesperson, that's a home run, right? And so it just makes their life a lot easier. The worst thing you could do, especially at a bulge bracket firm, right, is, well, your economist is really, really negative, but, like, you know, this guy is telling me, like, buy Caterpillar. Like, how does that work? Like, and like, whenever, as a salesperson, like, having to deal with that question from a client is annoying. You know what I mean? So whenever you can come up with ways to tie a macroeconomic view into, and this goes back to the business economics, right? I mean, tie a macro view to a market call, that's a home run, right? No one cares what your GDP growth view is. Like, I mean, you have all these, like, you look through the Wall Street research, and it's like in the back, there's like my GDP forecast. You have this big forecast table, and that's kind of what they're talking off of, right? But that's not really why I think people pay for research. People pay, you know, people pay for having an economics view that can be aligned with a market's call.
So let's talk about that economic view aligned with a couple of market calls. At least we'll look at the 2020s, because 09, 10, 11 seems like it's so long ago. Let's fast forward a couple of decades. Late in 2021, I very vividly remember most economists were fairly sanguine about inflation. Fed Chair Jerome Powell had said, we're going to let inflation run hot, the previous Jackson Hole. And you made a very out of consensus call. You had said in late 2021, economists were too sanguine about inflation, that the FOMC would have to raise rates, and you said at least 4 times. And that turned out to be very prescient. We started with 4 75 bip raises before we had 2 at 50, and then a sort of afterthought at 25. Tell us what you were looking at in 2021 that so many other economists missed.
Well, thank you for saying that. I mean, in hindsight, I feel like I wasn't hawkish enough. You know,
you were so much more hawkish than the average economist. I was more hawkish than
I mean,
hey, you know, most people forget sticking the landing. Most people miss the pool. You managed to at least give your clients a heads up. A Fed tightening is about to start.
Yeah, I mean, I caught the swing. I mean, I think. And then, you know, eventually I kind of came around to the idea that they'd have to do a lot more than what was priced. But I think, thank you for saying that. I did kind of catch that. But, you know, to me, it was just like a rapidly accelerating economy. It was, so basically the call, I think that the main issue there was, it was one call that you got right that kind of led to everything else, right? So basically, what I saw at the time was a V-shaped recovery. Mm-hmm. And so since there was a V-shaped recovery, that was going to have ramifications for all the other macro calls that people make, like whether that's the Fed, rates, stocks, you know. And so basically what I said was, we're going to have a V-shaped recovery. You could see it in the data. They basically turned the lights off, turned it on, and threw a bunch of money at the problem.
Yeah,
right?
$2 trillion solves a lot of headaches.
Well, it's sort of, you know, they fought the last war, right? I mean, they essentially, they diagnosed the problem as it was basically a supply shock. It was it was a very large negative supply shock that they treated as a big demand shock. And so when you have a demand side stimulus with a what is basically a supply shock, don't be surprised if you get like inflation.
Right.
And
$2 trillion in money coursing into the system and everybody stuck at home. Guess what they're going to do with that money?
And it's not just and it wasn't just Fed pumping, right? It was a fiscal stimulus, and so I think it's and also just like the behavior of people at the time. I mean, typically in a bad economic situation, you don't see people going out and taking out mortgage loans. But that's exactly what was happening at the time, right? So, housing is like one of these irreversible decisions. So you have to be really confident in things in order to buy one. And so when I started to see people like, mortgage purchase apps are like basically V-bottoming. Like it's just going straight up. Like there's signal there. And at the time, like everyone was thinking the bottom was going to fall out.
It was the opposite.
And it was in. And I remember at the time, I mean, in April of 2020, in the middle of April of 2020, I said, we bottomed. It's over. Whatever 1-2 week recession that we had, it's over. And I remember I got so much hate. I remember at the time, like, you had prominent economists telling, like, it's going to get a lot worse, like the bottom's still not in. But it was just sort of, it's one of these things in business economics where it's like up is up, right? Like markets they don't care about whether things are good or bad. They care about whether things are getting better or worse. And so, you can say it's not good, but hey, guess what? Like at the margin, we had more DoorDash deliveries in the third week of April than we did in the first week of April.
I don't remember if it was Ned Davis or it might have even been Ed Hyman who had said, don't look for when the economy is great or terrible. Look when it goes from terrible to bad. Like that's your first sign that you're making a bottom. Hey, this is really not a great economic data point, but it's so much better than it was last month. Maybe things are turning. Like that approach is when it goes from terrible to fair, you're moving in the right direction.
Yeah, and also like I mean, to me, honestly, like looking back on it, that whole period was the easiest call I made. Huh. And it's interesting because it was kind of out of consensus at the time, but I thought that it was so easy. I mean, you had especially like from a market's perspective, right? I mean,
stocks were straight up after.
Well, not only
that,
are we no longer going to have cruise lines? Are we no longer going to have airlines and hotels? Like it was just so obvious. Like, okay, these are like generational buying opportunities. You better just put everything you have into these names and just ride it out. Because anyway, I just thought. But to me, I think what I learned there is just, it's just important to kind of just pick a bunch of like indicators and see like, is it getting better or worse? And it was clearly getting better, right? I mean, you can't go down after you've gone down. I mean, in some of these indicators, it's like you can't just keep falling, right? And so there was stability. And by the second week of April, I think it was pretty obvious that things were turning around. And also the nature of the policy response, like, right? It was
huge, biggest GDP.
Well, not only that, but the way they were doing it, right? Like the phased-in approach. So, like, okay, so this week, like 10% of the economy's open, and then next week, we're gonna expand it out to gyms and restaurants, and then we're gonna expand it out to department stores and things like you know what I mean. So like every week they were kind of flipping on a bunch of on switches, right? And so obviously that was going to keep the economic momentum going.
So let's talk about another out of consensus call you made the following year. Very few economists were calling for no recession in 2022. Most were pretty bearish. And, of course, they looked at the Fed hikes that they had missed the previous year. You were one of the few people that were saying no recession in 2022. Was it simply that V recovery and just the robust momentum that was in the economy?
Well, I don't know that I said. I mean, I definitely understood where the recession call was coming from. I think for me, the bigger gap with the consensus was really going into 2023. And I had said there wasn't going to be a recession. And I think first, it's important to understand why people were kind of latching onto the recession call back then. It was basically because the Fed told you so, right? I mean, the Fed was basically saying, we need a recession to deal with inflation. That's what they were saying. When Powell, like, pain will be required, that's what he means, right? And so...
What did Larry Summers come out and say? Summers came out and said 10% unemployment to fight inflation. Turned out to be a little 1970s-ish.
Well, sure. I mean, what was the other 30% chance of stagflation, 30% chance of this, 30%, I don't know, whatever. But I think part of the reason, I mean, this is part of the way these models work, right? If you have a period of inflation, the model's going to assume that you need a recession in order to kind of get it back to target, right? So I think it's at some level, like one of the reasons driving the recession views on the street back in 2022 was because the Fed was basically telling you that's what they thought they needed to get inflation down. Now, by the end of 2022, I think it was becoming increasingly clear to me that we weren't going to have a recession. And again, I kind of put on my business economics hat, right? Like, so if you go back to that period, we had the Russian invasion of Ukraine. That sent energy prices through the roof. By the end of the year, gas prices had basically round-tripped, and the labor markets were strong. So we were going into 2023 with upward momentum in real incomes. Okay, so that's good. That should support consumer spending. Next, despite massive Fed hikes, like the Fed was going 75 bips a meeting, by the end of the year, what was going on with home building stocks? They were actually turning around, right? Home builder sentiment was getting better, right? Builders were in a much better balance sheet position. They were able to buy their buyers down in terms of mortgage rate buy downs, right? So housing,
and massive shortage of single-family homes.
Exactly. So housing was doing well despite hikes. You had governments spending a lot of money, like state and local governments were flush with cash, right? They got all this COVID money, so you had government spending, and then everyone was primed for recession, right? I mean, it's like this expectations. Element of it. If one of the ways I think recession happens is through surprise. If people think, things are going to be okay, and then they're not, then that prompts a clearing out of inventories and investment and so forth. And then, but if the opposite's true, then that'll happen, right? So if everyone is primed for recession and it doesn't happen, then there's going to be a period where you have to kind of gear up and invest in inventories and hiring and so forth. And so based on those four factors, to me, it was like by the end of 2022, it's like, yeah, we're not going to have a recession. Real incomes are growing too rapidly in order for that to happen, and the housing market's doing well. Like if you can get that right, if housing is working in the U.S. and labor markets and real incomes are growing, you're not getting a recession. So, and so to me, it was like a really easy market call because a lot of the weakness in the market was just predicated on recession risk. And so the more obvious it became that wasn't the case, it was, to me, it was very clear that, that equities were a strong buy.
So you've talked a little bit about the street predicting 4 to 6 rate cuts this year. They've been predicting that pretty much since 2022 and have consistently been way too dovish. What do you think the street has been missing over the past 2 or 3 years?
Well, I mean, I think the main story over the last 2 years, and I am a little bit more cautious now, but I do think the main story over the last couple of years has just been how resilient the U.S. economy is. And that's basically been the main story, is that we've had very, very strong income growth. We've had, obviously, a lot of state and local government spending, a lot of federal spending, but the main story, I think, has been, very strong growth in real incomes, which has been supporting household consumption. And if you get the consumer right in the U.S., pretty much everything else will fall into place.
So when we look out at the world today, we've seen a lot of volatility in policy. I hate the word uncertainty, but at least a lack of clarity, which seems to be affecting people's long-term travel plans, corporate CapEx plans. How significant is all of the back and forth on various policy issues out of the White House impacting your analysis?
Well, I do think that when uncertainty is high, it just makes sense to kind of double down and look at the data as it's coming in, right? I mean, you shouldn't try to make a big sweeping forecast if the uncertainty is high, but you should kind of think about just look at what's happening in front of you. And that's kind of what I've been trying to do. And, when I look at what's happening right now, I mean, I don't get a lot of optimism. I mean, it looks like the labor markets are continuing to cool off.
Still positive, but certainly at much lower levels than we saw 3 years ago.
Well, I think, to me, momentum matters, right? We talk about better or worse, right? I mean, the labor markets are clearly getting worse. And, is it nonlinear? No, it's not. But, one of the points that I've been making this year is that all recessions begin with a slowdown. Not all slowdowns end in recession, but we know that all recessions start with a slowdown. And it's pretty clear that the labor markets are slowing down. You have a very narrow kind of breadth of industries adding jobs. A lot of it is in kind of acyclical industries like education and health. So sort of the cyclical areas of the labor market are slowing down. You're seeing weakness in like white-collar professional services. Recruiting intensity is low, so the labor markets, I think, are to me, that's been my big theme for this year. Is that it's far more concerning than the consensus seems to appreciate, and I think also for the Fed. I mean, they keep talking about how the labor market is solid, and to me, that's basically a very like surface level analysis. Like they're looking at, okay, the unemployment rate is 4.1%, and therefore the labor markets are solid, but I think you can make a very strong case that the unemployment rate of 4.1% is really overstating the degree of health in the job market, right? Like when the unemployment rate is 4.1%, you typically don't see like the hiring rate as low as it is. You don't see the quits rate as low as it is. You don't see consumer confidence in the job market as bad as it is. You don't see even wage growth is slowing down, right? So
it's slowing down from a pretty high level. What is wage growth now? About 4%? Is that about
Well, it's
right?
actually slowing a bit more than that. I mean, it's running. If you look at over the last 3 months or so, it's around 3.5%. But 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 again, like if the labor markets were tight or tightening, then you wouldn't expect to see wage growth continuing to slow down. And you have ongoing increases in like the number of discouraged workers, right? You have a lot of people exiting the workforce. They're going straight from unemployment to out of the labor force. I mean, these are not things that happen in a healthy or solid job market.
How much of this is driven by the past 5 wacky years, including the pandemic and a giant decrease in people working, the recovery and people returning, plus the entire fiscal stimulus making its way through the system? It's not like 2025 is just one in a series of normal years. It's one in a series of very unusual situations, including, 525 basis points of Fed hikes in 18 months or so. So how do you contextualize this slowdown as the pig works its way through the python?
I mean, so this is sort of the argument that like the whole thing was just one giant like bullwhip, and we've kind of now we're still normalizing from all of it. I think to me that's possible, but it's just again like the sectors that are slowing down are not the ones you want to see slow down, right? I mean, you're at a point now where it looks like housing market conditions are continuing to deteriorate, right? Like prices are slowing. They're slowing in the markets where builders make homes. That's going to probably lead to job losses in the construction industry.
They're not getting any help from the Fed in terms of rates, at least no time soon.
Well, no, right. I mean, to the extent that the housing market is working, it's basically because sellers are capitulating, right? I mean, they're listing homes for market. They're willing to take price concessions. That's pushing up transaction volumes to some extent, right? So that's been okay. I mean, you have a little bit more elasticity coming into the housing market. But the fact that the labor markets are cooling down, what does that mean? Primarily, that's going to weigh on consumer spending, and that kind of sets in motion like a below trend growth outlook.
So let me ask you what I think is one of the most perplexing issues. Consumer spending pretty close to record highs right now, and at the same time, consumer sentiment pretty much still in the dumper, off the lows, but still historically low. How do we reconcile the robust spending with the terrible sentiment? Are one of those indicators, one of those measures broken?
Well, I don't know that. So this is like the vibe session kind of story. And I definitely...
Are you a vibe session person or no?
No, I mean, I think consumer sentiment... to me, what's really interesting about what's happened with consumer sentiment is how the link between consumer sentiment and labor market views basically completely detached following 2021, 2022, right? I mean, once inflation started going. So for most of my career, if you basically got like the labor market view right, you more or less would get the consumer sentiment number right. You know what I mean? Like,
but no more.
No more, right. I mean, so it's one of these things where when you ask someone, like, how do you rate the economy? It'll be like something like, it would be a very low number. How do you rate the labor market? It'll be a very strong number. And that's very perplexing, but it demonstrates that people don't look at the economy solely through the prism of the job market.
What else is kind of fascinating is if you ask people, how do you rate the economy? And they're like, meh, how do you rate your personal economy? Oh, I'm doing fine. It's like, how do you think of Congress? Oh, Congress is terrible. What about your congressman? Oh, he's great.
Totally.
So all of this brings me back to the question, is sentiment broken? When we look at the Michigan consumer sentiment, worse than the pandemic, worse than the GFC, worse than 9/11 and the dot-com implosion, worse than the 87 crash, it kind of makes me stop and think, are all of us missing how terrible things are? Or is just this methodology of asking people in 2025 what they think just doesn't work anymore?
Well, the methodology for the UMich number in particular did change. I think they moved online. But I just saw, to me, it's like consumer sentiment is basically a function of what stocks are doing, what inflation's doing, and what jobs are doing. Mm-hmm. And if you think about it that way, the drop in consumer sentiment made a lot of sense because inflation went really through the roof, right? And so that's why sentiment went down. Since then, you've seen some stability in inflation, and now that the stock market's back to all-time highs, essentially, you've seen some recovery in consumer sentiment, not surprisingly. But what I've been focusing on, it's there's this big debate about how useful survey measures of economic data are, like consumer sentiment, ISM, versus like hard economic data like manufacturing production, jobs growth. So to me, I think the bigger question for people in my field is like, how much do you want to weigh survey measures of economic data in your process? And to me, there is still useful information in these surveys, right? Like, so when you look at the Conference Board data, for example, it's another consumer confidence number. If you look at like the labor differential, so what are consumers telling you about how plentiful jobs are? How are jobs hard to get, or are they plentiful? That number still does a reasonably good job telling you or informing you about like tightness in the job market. Right, so if consumers are telling you that things are a little bit more slack, you should probably believe them. So, to me, it's about looking at which pieces of survey data are important and which ones aren't. Even in regional manufacturing data, right? You get asked, they ask the purchasing managers about their capex intentions. Again, it's another indicator. It does a reasonably good job, like mirroring the broad ups and downs in business investment, like core durable goods. So.
I think the purchasing manager seems to be, that survey seems to be a little less out of sync with spending than consumer sentiment is with either labor or consumer spending. Fair statement?
Yeah, I mean, the consumer sentiment number doesn't look like consumer spending. I mean, that is true. That is true. There are elements within the consumer sentiment stuff that kind of make sense. But, broadly speaking, you're right. Consumer sentiment is dramatically understating how much consumers have been spending. That's true.
So we're talking about all these different U.S. data series. How do you incorporate global macro trends and global economic data into your models?
I'm going to be honest with you. I don't spend a lot of time focusing on the rest of the world.
Really?
That's probably to my own.
I mean, especially
detriment.
these days with Europe outperforming the U.S. and emerging markets doing well after underperforming the U.S. for 15 years.
Yeah, I mean, what's interesting is that you look at, it's right. I mean, that has been notable, like the outperformance of the euro. You don't really see much outperformance in growth dynamics, so it kind of tells you, like sentiment in these towards Europe has been so depressed. So
Right.
there's been like some incremental improvements, some incremental narrowing in growth differentials, and everyone's thinking that like Europe is off to the races. But I don't really see that in the data that we look at. I mean, if you look at purchasing manager surveys, for example, in Germany, I mean, they're still well below. I mean, they're still below 50. I mean, German manufacturing, French manufacturing have been in the kind of dumps for a while now.
And Germany is in the middle of economic contraction, right?
Yeah, I mean, it's there's been a lot of it seems like a lot of like hopium based on like defense spending and fiscal reflation and so forth.
Huh, really, really interesting. Let's talk a little bit about the possibility of a recession in 25 or 26. What do you think is the most significant macroeconomic risk facing the United States right now?
Well, I mean, obviously the one that's getting the most attention is erratic trade policy. But I don't think that by itself is what's going to cause a recession. I think it's primarily like monetary policy is too tight. You have nominal GDP slowing, and the Fed funds rate is not doing anything. It's basically flat at 4.5%. So to me, that represents a passive tightening of monetary policy, and that'll continue to build pressure on the economy, particularly on the labor market. So kind of go down the list, right? I do think that the left tail risk of the distribution has gone up. Number one, I mean, labor markets are cooling and income growth is slowing. That's probably going to weigh on consumer spending. That was true even before tariffs came into force. If you look at housing, residential investment is probably slowing because home prices are now declining, particularly in the places where the builders are making the homes, right, which is like the South, Florida, Texas, Arizona. That's weighing on construction activity. If you look at business investment, it's probably welcome that they just passed this tax law. That gives some certainty around the tax outlook, but at the same time, some of that effect is going to be blunted by what's going on with trade. So you haven't really seen much in terms of, outside of AI, business investment's been quite sluggish. So
it sounds
and then you
like
have state and local governments cutting back, right? So it's just sort of, it's a very unstable kind of equilibrium, in my opinion. And I do think that, if as consumer spending is slowing, that creates risks for the U.S. economy.
So is your base case that a recession in second half of 2025 or sometime in 26 likely, probable, possible?
Yeah, I have it on the board. I mean, I definitely think that a recession is more likely than not. And specifically, I think you'll see a period of, a quarter or two where you get a series of negative employment reports. And I think that'll push up the unemployment rate and probably bring in the Fed to cut more aggressively.
So unemployment rate ticks up to 4.5%, 5%. Where do you see this going? 5.25%?
I don't know it goes up that high, but I can easily see it getting it close to 5% at some point over the next 12 months. Sure.
Mm-hmm. And that forces the Fed to. So let's talk about the Fed for a second. Once the first CARES Act, which was $2 trillion, 10% of GDP, the biggest fiscal stimulus since World War II. Once that was passed, it seemed like the Fed was increasingly behind the curve. We saw inflation start to tick up in 20, but really take off in 21. And they kind of sat on their hands until, when did the cycle start? March or April of 2022?
That's right.
And by June, it was inflation peaked and started heading down. And so it seems like they were late to recognize inflation. They were late to tighten. Now it seems like they're late to start cutting, at least in your assessment. Is the Fed just a big, slow, ponderous institution, and they're always going to be behind the curve?
Sound like Trump. Too late. Too late, Powell.
By the way, you're the first person to ever accuse me of that.
Yeah.
But to be fair, hold aside the beef between Trump and Powell. For my entire professional career in finance, it has felt like the Fed is always late to the party.
Yeah, I mean, I think
they're just conservative and slow, and they would rather be late than mistaken, I think is a fair way to describe it.
There are times when they're even by Powell's own admission, like last year, he said that when they went 50 in September, that even that was a little bit late.
Mm-hmm.
It's a consensus-building institution. You have to kind of corral your colleagues to your view, and so that to me might be one reason why it's a little bit slow. But as I say, I mean,
so we've talked a little bit about, or you brought up how much uncertainty there seems to be around the tariff policy, especially on again, off again. What are the risks from the tariff policy? Could this be a factor in the recession? What other knock-on effects do you see from this new policy?
Well, I think the main effect is that it freezes business investment in place, right? I mean, that to me is the big story.
Nobody wants to commit hundreds of millions or billions of dollars till they know what the policies
what trading
are.
relationships will be with all these other countries. Mm-hmm. Sometimes you're announcing tariffs with countries we may already have trading agreements with.
South Korea, we have 2012.
Korea is a good example.
Sort of bizarre.
Yeah, I mean, and look, like this to me is like it's the return of like the Trump collar strategy, right? I mean, one of the things that we thought very early on was that essentially he's going to be testing the market, right?
Mm-hmm.
I mean, if the market gets, it's sort of bounded in a way, right? A strong stock market, maybe he pushes the trade dial up a little bit. Then if the market sells off, maybe he'll back off, right? So it's sort of he's trying to find an equilibrium for himself that he's comfortable with, that to me, for businesses, right? Like to me, it's as simple as part of his shtick is chaos.
Mm-hmm.
And the business community doesn't like uncertainty. So that's a fundamental tension. But I think, so that's going to weigh on investment spending. But I think in the background, you still have this kind of slow bleeding in the job market. You have this ongoing cooling in consumer spending. You have this slow sort of bleeding out in the housing market. That's weighing on construction. So, and you have, state and local governments cutting back. So you just don't have as many drivers for growth. And ultimately, that becomes a problem.
So what is going to finally push the Fed into beginning cutting rates? What do you think is the most important data series they're looking at? I really don't imagine anyone cares whether inflation is 2 or 2.25. But if we see, as you mentioned, a negative non-farm payrolls print, that has to get their attention, doesn't it?
Yeah, I would think so.
What else might get their attention and start a new rate-cutting cycle?
To me, the most important thing is seeing what happens with, essentially labor market slack, right? I mean, if wage growth continues to slow down,
mm-hmm.
then the ability for households to essentially absorb tariffs is non-existent, which
mm-hmm.
makes it very difficult to see where you get inflation from. So
mm-hmm.
right now they've been kind of making this point that the labor markets are not a source of inflationary pressure. If you get further slack in the labor market at this point, like at that point, maybe the labor markets become a source of disinflationary
mm-hmm.
pressure. And so I think that's something they have to keep an eye on.
What else might capture the Fed's attention and say, hey, we're really behind the curve? What do you look at in the housing market? Is it just new home starts or?
Well, prices are slowing, right? I mean,
mm-hmm.
that to me. So it's
but they're not negative, and especially in the coasts, in the big cities, and in
well, prices aren't negative in the Northeast, but if you look at like California, like inland California,
Florida also,
prices are down. They're
mm-hmm.
they're contracting outright in
mm-hmm.
places like Texas, Florida, inland California, Arizona.
But they've experienced giant booms over the past 5 years.
They have, but at the same, I mean, I would just that's true. But to me, again, it's about what's happening at the margin. At the margin, prices are contracting,
and that matters.
And that matters, and inventories are rising, and to me, that's the main asset on most households' balance sheet. And if you look at home prices, I mean, there is an important link between home prices and actual price inflation, right? I mean, you can just look at the data. The cities across the country that are experiencing the most home price deflation are also the places where you don't see much consumer price inflation. So I think that's notable.
So in one of your more recent research pieces, you talked about the importance of the U.S. dollar. Why is this such a huge factor on a macro level? What are we, down 10% year to date in the dollar? How significant is the dollar to the rest of the economy? And let me know if you didn't say that. I have so much stuff in my head I can't keep it all straight.
Well, I mean, the dollar is important. Typically when you have a weaker dollar, right? I mean, you should assume that you get some upward pressure on core inflation. I think what's notable about what's happened with the dollar is that it kind of went the other way in terms of what people thought, right? Remember the big line? The line was that, we're going to put these tariffs on. A lot of the shock is going to be neutralized because the dollar is going to get stronger. Didn't actually happen. Yeah. Right. Well, I mean, it did for a day, mainly against EM, but most of the weakness in the dollar actually was against G10FX. So, but at any rate, I mean.
So what's the significance of the dollar to the economic cycle, to things like foreigners buying U.S. homes? Is a big driver in a lot of cities. How significant is the dollar to either a recession call, inflation, or real estate?
Well, so I mean, I think it depends how. I mean, so it's interesting how you're framing this question. I mean, I think. Remember, in macro, like, everything is correlated, right? So if the dollar, to me, it's really about why the dollar's moving the way it is. So let's say I'm right and we go into a recession, I would assume the dollar to be strengthening in that environment, right? Because it's a safety play, right? So if the U.S. economy is weakening, then people are going to seek out safety, and that should push the dollar value up.
You mentioned in April that it was potentially a worst case scenario. And in that month, after the big tariff policy announcement on April 2nd, we saw bonds weaken, we saw stocks weaken, and we saw the dollar weaken.
Right, this is the whole sell America trade. But if you go back to that, though, right, Barry? I mean, if you look at the number of times where that combination of things happened, I mean, you could probably count on one hand how many days that happened. So it was one of these things where the narrative kind of got way out in front of what was actually happening. And now here we sit a couple of months later, and we're talking about U.S. equities at all-time highs. And, so, I mean, I think, maybe part of it is maybe there's a little bit more enthusiasm around what's going on in Europe, right? I mean, Europe is taking steps to reflate their economy. That's good for the euro. You have... at the margin, like, people are a little bit more optimistic about emerging markets. Emerging market currencies have been doing better. So, there's this train of thought that, like, the dollar is purely a function of, like, the Trump moron risk premium. But that to me, it doesn't. I don't think that goes. That might be some of it, but I don't think that's nearly all of it.
That is. I've heard taco. I can't say I've heard. More on risk premium before. That's a new phrase. Don't send your hate mail to me. Let me throw a curveball question at you before we get to our favorite questions. What do you think investors are not talking about, but perhaps should be? And it could be any topic: assets, geography, policy. What data point is getting overlooked, but is important and people should be paying attention to?
Well, I think what's interesting is this sort of the Trump apprentice show with the Fed chair. I think that's becoming. I mean,
Scott Bessent.
There's a lot of right. I mean, there's this whole talk about a shadow Fed chair. Right. What if you get into a situation where, by Trump doing what he's doing, do you actually get him naming a chairman in name only. Because
like Kevin Hassett.
Yeah, or no, but basically, in other words, what I'm saying is these guys are trying to get this done early, essentially to kind of create a condition for some sort of shadow Fed chair, right?
With no authority, no power, no ability to move rates.
Well, that, but also maybe someone that's. But then, if this person ends up becoming the chair, does he actually become a chair in name only because Powell is still sticking around? Right. I mean, that to me is what's interesting. Is
when does Powell's term end?
Well, his term as chair ends next May, but his term as a governor doesn't end for another 2 years after that.
Oh, really?
So that to me is something that, that's a pretty, that's a card he can play, right? And the way they're going about this, you talk about, we talk about like Supreme Court justices and like litmus tests when you name, right? Like they have a litmus test for judges. Trump is creating a litmus test in a way for monetary policy officials, right? He wants someone that's going to cut rates.
Someone who's not going to be independent.
Exactly. And so I do think that this desire to have this kind of like big show, like The Apprentice Monetary Policy Edition, and this sort of like, shadow Fed chair, trying to kind of undercut Powell before he's done with this term, that could potentially backfire on them, because it would just mean that it's possible that if they actually get whoever they want across the finish line, once they're there, they're a very weak chair because Powell decides to stick around.
That's really quite fascinating. I haven't heard anybody talk about that. So that is very much an under the radar answer. So let's in our last few minutes, let's talk about our 5 favorite questions we ask all of our guests. Starting with, tell us what you're streaming these days. What are you listening to or watching?
What am I watching? I just finished The Handmaid's Tale.
Oh, really?
That they had their last.
Did it hold up through all these seasons?
I thought the last season was actually pretty good. So I like that. I just watched Netflix, The Poop Cruise. That was pretty fun.
Oh, really?
Yeah.
That's people stuck on the boat in the beginning of the pandemic?
Yeah, it was a good like.
It's such a horrible title.
It was a quick documentary, but I kind of enjoyed it. And yeah, those are the 2 things that are sort of top of mind for me.
Those are very eclectic, not at all similar. I walked in on my wife watching The Gilded Age, and somehow I got sucked into this, and it's really quite fascinating. Because all the issues that we argue about today, wealth inequality and new money versus old money and economic strata and economic mobility, themes of the Gilded Age 150 years ago. It's amazing that everything's changed and nothing's changed.
Right.
It's kind of fascinating. Let's talk about mentors. Who were some of your early mentors who helped shape your career?
It's interesting. I think about. I remember you asked me this question the last time I was on, and I probably said, Ethan Harris.
Right.
I think I'd put Drew Mattis in that category of mentor. But I'm also at the point now, I feel like, in my career where the people that I idolized early on are now actually like my rivals, right? They're my competitors in some respects, right? I mean, you talk about Rosie. I mean, he and I are both in the research business, Right. So it's sort of. It's interesting.
If you're bearish the same year he's bearish, or at least the same quarter, that's an unusual alignment, because for as long as
that might be true right now.
Because for 15 years you've been fairly
bullish,
constructive, and you can't say the same of Rosie. This could be the first time, second half 2025.
We're aligned,
right? But that just means you've shifted, because he's been sort of.
But so now it's more about like not so much mentors, but like who am I talking to kind of help me work through my process as like an analyst. And some names that come to mind, like Connor Sen, your Bloomberg
Sure.
opinion colleague. I like talking to him about the economic outlook. We sort of think about and come at things the same way. Luke Kawa is another one. I like so these are sort of like, I guess you could call them like geriatric millennials like myself. Like we sort of
Geriatric millennials. Again, another phrase I've never heard before.
Skanda Amarnath is another one. I mean, he's sort of in like more of like the public policy space, but I mean, I'm kind of glad he doesn't do it, but he'd make a great business economist himself. But I mean, these are people that I just like talk to kind of stress test my own views, and I think that's at this point in my career, like that's what I need more than mentors is sort of smart people that will help me, you know, kind of think through an outlook and stress test.
Sharpen your focus.
Yeah, or just like where are you wrong? Like what are you missing?
That's interesting.
So that's sort of how I think about it now.
Let's talk about books. What are some of your favorites? What are you reading currently?
You know, I don't read books. I'm not a book reader.
We talked about this last time.
We did. I read the news.
Right.
I can tell you who are the people that I like reading, you know, in journalism.
Give us some names.
Like Nick Timmeros, Wall Street Journal.
Sure.
Love reading his stuff.
The Fed Whisperer these days, too.
Well, I mean, it's not just that, but he has like a very like, you know, I mean, he thinks about things very thoughtfully too, and he you know, he does a little data watching himself. So I kind of like reading what he has to say. Jonathan Levin, Bloomberg Opinion. So you know, those are your colleague Josh Brown. I read his stuff. So
he's a very thoughtful writer.
Yeah. So to me, it's really I you know, I don't have time to read books because I'm too busy like reading you know, reading the news, reading opinion pieces. The most interesting Fed paper that I came across recently is just you know, we talked a little bit about Ed Leamer before, but the Fed recently published a paper just looking at the housing channel of consumer spending, right? Like, so they were basically making a fairly obvious point that if housing transactions or new home sales are down, like that's going to have effects on housing-related consumer spending, and that's something that we should be thinking
Durable
about.
Goods,
Exactly.
straight across the board. Yeah, absolutely. Housing has always been a big driver of the economy. What's been so shocking about this economy is we've seen home transactions drop significantly just because there's no supply, but the economy has been so resilient. It's really been kind of fascinating watching that happen.
Yeah, I mean, it's interesting. I mean, so again, like housing is one of the reasons why I'm cautious on the economic outlook. And, you know, I think what's different about this time with respect to housing versus, you know, early 2022 is that now units under construction are coming down. You're in a situation where starts are running below completions, which means that essentially units under construction will have to keep falling. And that's not what you had last time, right? Back then, units under construction were going up.
Really?
So to me, that construction piece of it is different this time versus last time.
Our final two questions. What sort of advice would you give to a recent grad interested in a career in either economics or investing?
I mean, to me, it's just get a foot in the door, you know, figure out the details later. You know, it's sort of, it never works out the way you think, but you just have to put yourself in a position where you have the best chance of succeeding. And that to me is the best advice I can give someone. So in my case, that manifested itself in get your foot in the door at a bulge bracket firm.
I mean, you literally were working in HR before you moved into economic
100%.
research.
Yeah, it doesn't like. To me, it's about putting in yourself in a position where you can succeed, and I think that that's definitely true. I mean, for me, it's a number of ways that happened. Right? I went to NYU. Because I knew that if I stayed in New York, I'd probably have a better chance at things than if I left. And it's just, you know, I mean, NYU, you know, it's not like the best school. It's not like Princeton or Harvard.
Still
but like,
a pretty good school.
It's a pretty good school, and it's
the business. Stern is a great business.
Yeah, and if
school.
you're in New York, recruiters are gonna come after you if you went to NYU. Right. It's just that simple. And
you just need the $100K a year.
Well, yeah. I mean, it wasn't that much when I was going, but my advice would just be, you have to put yourself in a position to succeed and just let the chips fall where they may. I mean, that to me is, you know, and if that means taking a job that maybe not the best job, but it's at a firm that you have a lot of, you know, respect for, or it's a good firm, good brand name, take it.
Our final question, what do you know about the world of investing today you wish you knew 20, 25 years ago when you were first starting out?
That's a tough one. I mean, I think my favorite thing, to me, what's important is, and just trying to relay this back to my seat, is it's important to understand the time horizon of the person that you're talking to and you're providing analysis for, because a lot of people live in the short run. Mm-hmm. But if you're sort of a typical investor, you can tune out a lot of the stuff that we're talking about, to be perfectly honest, because to quote my friend Sam Rowe, stocks usually just go up. And so, it's sort of, you see all this analysis that comes out on the street, like, after the ISM goes to 40%, like to 40, usually the stock market's higher 6 months later and 12 months later. Well, yeah, obviously, because the stock market... But
that's a default set. It's depending on the decade you're looking at. It's 3 out of 4 or 4 out of 5 years.
Yeah, so to me, it's sort of... I would tell myself back then, like, don't worry so much about making big market calls. Just give people your thought process.
Mm-hmm. Really, really interesting. Neil, thank you for being so generous with your time. We have been speaking with Neil Dutta, Head of Economic Research at RenMac. If you enjoy this conversation, well, check out any of the 550 we've done over the past 11 years. You can find those at iTunes, Spotify, YouTube, Bloomberg, wherever you find your favorite podcast. And be sure and check out my new book, How Not to Invest: The Bad Ideas, Numbers, and Behavior That Destroys Wealth, and How to Avoid Them. How Not to Invest, at your favorite bookseller right now. I would be remiss if I did not thank the crack team who helps me put these conversations together each week. My audio engineer is Peter Nicolino. Anna Luke is my producer. Sean Russo is my researcher. I'm Barry Ritholtz. You've been listening to Masters in Business on Bloomberg Radio.